How's it going, guys? This is Matt. Just wanted to record a video about legging in. I've been getting a lot of questions about, the whole concept in general as I've been talking to people, and probably because I've told everybody that trades that this completely changed the game for me. Because the worst trade of your life, I know you think it's that big loser you had, but those, yeah, those are bad, but they don't tend to happen very often. If they do, um, you might be in the wrong profession. But the worst trade I can have, and that hurts the worst, is when you get into a trade at a great entry point and your stop is too tight. Say you have a stop right here. It's just too tight because your position size is either that big, and according to your risk protocol, you have to have it there, or for whatever reason you put it there. Whatever the reason, the worst trade in the world is when you get in and you get stopped out and then watch it run a mile. That will be the worst trade of your life. So I wanted to quickly explain the legging in concept. I used to be a fund manager, and this came really counterintuitively to me, because as a fund manager, when when you own a stock, you have a theoretical position size from 1 to 100% in each stock you own. And I was an all cap growth manager, so I would have micro cap companies in my portfolio, and when those would double and triple and quadruple in size, I would automatically have to pare them back and harvest profits, because otherwise they'd become 10% of the fund sometimes. So also, there are other concerns there. Didn't want to own too much of the stock, otherwise we'd have to file forms and all of that, do proxy voting and things like that. But anyway, off topic. So this came really, it didn't come naturally to me. In a fund world, and you've all heard it, dollar cost averaging, right? So, if I love it at 30, I'm going to really love it at 20, kind of thing. Well, in this world, we don't like adding to losing trades. We like adding to winning trades. And the sooner you can get that comfortable in your mind, the better. I'm not saying you have to add to winning trades, but I'm just going to show you a little bit, an example here of how it can really help you. So legging in, so first of all, legging in means that you start with a smaller position than you normally did before you started practicing this. So, and I created a little spreadsheet. Here it is. So let's say we have $100,000 account. Let's say we used to enter with, a lot, one standard lot. Well, in order to, and let's say we usually like our our stop loss to be about 30 pips away. Well, let's enter with 50,000. And now to get that same stop loss or same loss potential in dollars, we can do a 60 pip stop loss as far as distance goes away from our entry price, which, that's way below. So it doubles the distance. If you do a third position, you can do 3 times the distance, and yet you're still not risking any more dollars. When it comes to stop losses, looser is better. You want to give your trade, as long as you're doing all that you should do, and you're checking all the items off the checklist and entering when you should, then you want to give it time. You want to give it latitude and flexibility to work for you. Because typically, and it doesn't always happen, but typically you should start to see your trade work for you relatively quickly if you got in, when you should have. If it doesn't happen that way, which does happen, especially, particularly a couple months ago, when the market was really volatile in the Forex space, you'd get in at what quote the right time, checking off all those boxes that you need to, and suddenly there'd be a power reversal and it would stop you right out. Well, that's okay. That's okay. Those happen. In fact, sometimes those happen a lot. But as long as you're following your trading plan, and doing the things that you need to before you enter a trade, you should be fine in the long run. The numbers will take care of themselves. So anyway, what I like to do, so on this one, why would I get in here? Well, this is huge. So we have a lot of volume. It goes above the 50, closes above the 50. And the 50, as we know, is very important to traders, to technical investors. So breaks above the 50, and from right here you can tell there's a reversal from this downtrend. But I want it to be above the 50, and I also want it to be, once it crosses the 50, I'm going to look for the next swing high that we hit, and it looks to be about there. So I would enter here, and where I typically would place my stop is the next. So looking downward, the next logical place for it to be, either at the 50 or, maybe there, which is the swing high. Did I say that was swing low? That's a swing high. The next swing high down from it, but that looks really tight. So I'm going to have it, I definitely don't want it to cross the 50 and go very far below it. So I'm going to put it down here where we had this swing high. But in the spreadsheet, if you put 50,000 in, oh, and I have the wrong pair here, sorry. Let's go ahead and get the right pair. We are US or Euro dollar. There we go. Technically, I could put my stop loss at 1.16152, and you can see over here that that's not even in the realm. I mean, that would be way, way down here. But I mean, who wants to wait for that to happen to understand that this trade isn't working? So it really only comes into play when you start legging in and using leverage. Then you're for sure going to want to use this spreadsheet. So, I did not use the stop loss that it says I can. By the way, I'm using a 2% of account value that I'm willing to lose in any one trade, and that's $2,000. That doesn't change. So as we're going, I see another entry point here because it forms this. It's a rather loose base here, but that's okay because we had no volume here, which is fine. Yes, it says the histogram says that sellers were coming in, but wow, the volume is just non-existent. So compared to maybe buyers, well, they just ran it up from here. So buyers want to give the moving averages a chance to catch up. It makes them feel warm and fuzzy when they have that 20 period SMA supporting or butting up against the new price before they want to move this thing higher. So there's a run up, consolidation. Then we have this basing period here. So I saw this as another legging in opportunity because now it's breaking out of this base, the high of the base, and I'm using the wicks or the tails to judge. I don't typically use the bodies; I use the tails just because I'm conservative. So let's first record this first trade. Where'd we get it? Oh, it looks like I've already put all these prices in. Good. So we got it at 1.20152. This is the position value in US dollars because, it's US dollars is actually in the pair. So as we know, with a standard lot, 1 pip will equal $10. Well, with a half a lot, one pip is going to equal $5. So percent position. All right. So let's say we leg in here, and let's get that other half of that standard entry we used to have in there. Now, and that's the price for the second entry right here, 1.20564. I might be a couple tenths of a pip off, but either way, you get the picture. So what this does is it takes an average of your entry price. So since you did 50 and 50, it should be the average of these two numbers, which is 1.20358, which is exactly what we have there. Again, this tells you where you could have your stop loss and still not violate your risk protocol in your trading plan. Okay, well, let's start to use some leverage on these other ones. So on this one, we see that the histogram, that the sellers are basically dying. They're going to take a nap for a while, and the buyers are coming in force again. And it's all relative, right? Even though there's still lower volume, it's all relative. So let's do 3 standard lots here. Now we're into levered territory, right? Because our account value is only 100,000, but now we've added another 3 lots. So now we're levered 4-to-1. Well, this takes that into account. So, by the way, after this second move here, I would move this stop up to, I still want to give it room, so I'm going to move it to the bottom of the base, which is typically where you want to. That's typically where we should have our stop loss, is at the bottom of the base, because that was our recent swing low, right? So here, well, this is telling us that now 1.19929 is the lowest, or is the highest, let me think about this, is the lowest it should be to not risk more than $2,000. So let's see where that is. Well, it's still lower than where we have it now. So we can still, I would still bring it up, maybe there, because in this basing pattern we have here, that's the new swing low. So I would still bring it up, but this is just telling us that it could be lower. Now this is a really quick high and tight base we have here, and it breaks out again. Breaks out on good volume, with good participation amongst investors, and this continues to go higher. The sellers are still on the floor. So let's say we do 5 more lots. Okay, now this is our average cost here. Now this is telling us we need our stop at least no lower than 1.20348. So let's see where that is. 20348. That's still down here. So we don't really need to move it, and I probably wouldn't. That's too tight to put it there. Because if we would have gotten in here, I don't know if this went up before it came down and then came up again, but I don't know if this tail was visible by the time I got in. So, and this is just an example. I didn't actually make this trade. So we could have it down here and still only be risking 2,000. Well, what if we had done 1 million here? So 10 lots more. Now we'd need it at 20591. So now we would need it right just below there. 20591. That's where it'd have to be if we went in with $1 million there, this is what we have right now. So we have 14 lots into this investment. And the great thing is now any increase in PIP, see, this is position PIP value. So any increase in PIPs as you're going up now mean a lot. I mean, if in one standard lot you get $10 per PIP, now we're getting 100. Well, let's on this next one, I'm just trying to make a point here, but let's do another. Maybe not that much. So we got 68% of our max size in this one position. This is our average price now. This is where the stop loss would need to be. So, whoops, forgot what that said. 1.20914. So what I'll do is just 20914. On this last one, that's where the stop would need to be. So you want to make sure that you're using this spreadsheet, or any spreadsheet. You guys can create this. It's not that hard, but and you can you'll be able to find this in the FX Tools page on the site. I'm going to place it there right after this video. So you want to make sure you're keeping your stop loss at a place where you're never going to be risking more than whatever your risk protocol is. Personally, mine is 2%. Yours may be 1%. We have traders that are 0.5%. We have traders that are 3%. Whatever it is, you want to be consistent, and you want to make sure you're adhering to your trading plan. So anyway, on that last leg, this is where it could be. And let's just say we exit there. So after that, and obviously you'll have your profit, but what you're getting is on these last ones where you're entering in big, you're getting a lot of money per pip. So it doesn't really need to move that far to get a lot of profit. So, I mean, you may even want to, beef these up and then move the stop to the appropriate place. But this has been a great tool for me because, like I said, early on in trading, I would place the stop too tight because I would have a big position size, and my mind just worked backward to the way it does now. In that I'd want to go in big, but that would force me to have a really tight stop loss, and I would get stopped out and then watch it run. And I hated that. So this is a great practice to have. And you can try it. Like I said, I'm going to put this on, and you can just practice, just fool around with it. And has the put in, make sure you're putting in all of the exchange rates as often as you can. I have mine connected to there's an Excel connection that you can have that puts it in. And then this will calculate automatically for you. But this has been great for me because, these initial stop losses that it gives me are just a mile away. But again, I usually don't like any more than, 60, 90 pips. 90 pips for a third position. I mean, 90 pips is a mile away. If it doesn't work out and you've given it 90 pips of leeway, chances are that trade is not going to be a good one. You want to get out of it before it actually has to go hit your stop loss. Don't wait for it to go 90 pips down to get out. Just get out because there's always another trade. And I guarantee you, I've never seen one of my good trades go down 90 pips before it actually goes my way. So, go ahead and try this out. If you have any questions about it, let me know, and I'll be happy to explain anything. But that's it, and hope you're trading well. Contact us with any questions.